Hello, everybody. I am Daniel. I'm the founder of Startup CPG. Welcome to the second part of our Finance 101 series with our friends from Finaloop. This one is a banger. I'm really excited for this. Thank you all for joining us. And if you're watching on YouTube, make sure you hit the subscribe button. Working capital, really critical part of it. If you missed the first one, don't worry, you can watch it back. It's saved up on our YouTube, so definitely check it out. And I'm really excited that we're joined by two people today. So we've got David from the Finaloop team, who has just put in tons of time just to help educate all of us and put together some really nice materials. And I think my goal for all of you guys is to sound smarter than I ever felt like I did when, you're talking to investors or anybody who really has basic or advanced questions about your business, because the people who can spit back numbers and just look and sound confident, I think are the ones who make investors and other people feel very good about them being in control. And I'm also really excited to welcome our very good friend, Jamie Valenti Jordan, who has done tons of content with us and I have known for many, many years and still have yet to stump with any kind of an operational or ops finance type of question. So welcome to both of you. And I'll go ahead and pass to you, David, to start with some intros.
All right. Well, thank you very much, Daniel. Great being here. So we had a great session last time, and I think today's session on working capital is going to be really great. So just a couple of introductory words. First of all, Jacob, I head ecosystem education here at Finaloop. We do lots of these kinds of events like webinars, podcasts, in-person events, and I think it's really just a great way to interact with the market and educate people about finance. And I think this, like I said, is going to be a great session. So hope you guys all enjoy it. And if anyone has any questions that do not get addressed throughout, feel free to reach out to me. I'm Jacob Becker on mainly on LinkedIn, also jacob.becker@finaloop.com. We could drop that in the notes as well. And I think let's get started.
Let's do it. And sorry, Jacob. People always ask if the slides are going to be sent out. They are. If you're here, it means you registered. You will get the slides. The recording will go on the YouTube. So that's where you should subscribe. And I just dropped the link in the chat. So sorry, Jacob, go ahead.
Yeah, great. Okay, so we're going to be speaking about, on the first session, we discussed mainly the P&L and different metrics you could pull out of the P&L and how to optimize your business. And now we're going to be focusing more on the balance sheet and cash flow statements and where working capital meets us there. Meaning the main metrics we're going to be looking at a little bit at cash, a lot at inventory, AR, AP, how they all interact with each other, how this impacts your inventory turnover, your cash conversion cycle. We'll kind of try to address how tariffs impact this all. I think Jamie will have a lot of great comments just from like an upside and maybe from just a lot of his experience in the market. We're also going to be speaking about some metrics pulled out. We at Finaloop, which I'll speak about in 1 second, we work with lots and lots of brands. So we have a lot of really interesting data, which will kind of help you benchmark, just like we did in the P&L session here too as well. Is your working capital looking good? How does it compare to others? What your inventory turnover looks like compared to the category you're in and your revenue, etc. Okay, now just 2 words about Finaloop before we start out. So like I said, I had education here at Finaloop, which is an accounting software plus service providing fully reconciled real-time financials for D2C brands, multi-channel, omni-channel, wholesale. We pretty much pull data from your stores, from your payment processors, from your banks, payroll. We have proprietary inventory systems, etc., which give you really cool real-time financials like P&L, balance sheet, cash flow, which you can pull things like working capital out of. And also pull various metrics out and see where you stand compared to the market. So feel free to scan this QR or the URL below. I'll show this slide at the end, just if anyone wants to hit that as well. Okay. Now diving in, so this is kind of something we discussed briefly last time around. I just wanted to reiterate to make sure we're all aligned and on the same page. So the 3 main financial statements that you're going to meet and see are the P&L, which again we discussed last time, which just to Sum it up, tracks your profitability over time, looking at the one hand at your sales, which will be your total sales, taking away your discounts, promos, refunds, etc. And then your various cost centers, like your COGS, like your variable ad spend, like your OPEX. And then at the end of the day, on the bottom line, it will give you your profitability. So you can look at your profitability at a company level, at a channel level, or even at a SKU level. And it is super important. Okay, so that's what we discussed in the past. We're not going to dive into that today. Second is the balance sheet. The balance sheet, you can have two companies that have identical P&Ls that look totally the same, but they have very different health profiles. And when you look at the P&L, you're not going to see that. But one company really has been bootstrapping since day one and have a really healthy debt to equity ratio. And the other company has been totally over leveraged and they're about to collapse. And you're not going to see that when you look at the P&L. You will see that when you look at the balance sheet, because it's going to be looking at your assets, which is what you own, your liabilities, which is what you owe to others, and your equity, which is your assets less your liabilities. So we're going to dive into that and how that touches working capital in just 1 second. And your cash flow statement, the third of these statements, which we're also going to touch today, which is more operational, monitors your cash flow, meaning it either starts from the P&L and takes into account various movements, or just takes everything, all of your cash flows in and out of your company in a given period of time, and it kind of reconciles what your cash is at the beginning and what your cash is at the end of the period. And just one statement, which is a common question which comes up all the time, especially if you're doing accrual accounting. If your P&L represents profit, your cash flow represents cash. So just because you're profitable doesn't mean you're going to have cash. You could have a really good net margin. You could have 10, 15, 20%, much higher than your median. You're looking great, but you have absolutely no cash to pay for your next inventory order or to pay your employees because all your cash is stuck in inventory or in AR. So we're going to be discussing that today. And a lot of what we're going to be discussing when it comes to working capital is that sometimes everyone, like a lot of people just think about the P&L, but if you think about it, a lot of times it's worth trading margin points of the P&L to have better cash flow. That's going to be one recurring theme. Yeah, sorry, Jamie.
Yeah, just to kind of point out why all of this is important. When the only reason that companies really end, in a fireball is when they run out of cash, which is why understanding how all of these things work together to understand what your cash flow position is today and what it's going to be in the future is really what I think we're getting at the heart of as we're setting all of this up. Because the only way that you really run out is when you have the inability, you no longer have the ability to pay your debts.
And I would say either it could end up in a fireball or in a lot of these acquisitions you guys are seeing, even the kind of public ones that look like successes, a lot of those are companies who ran out of cash and basically had to do a forced sale. So very important, obviously.
Right, right.
Mhm.
Okay, so now moving on to the first of these two, the balance sheet. So it's great for tracking your working capital, which it's kind of divided into like current and long term, which means you have assets that are current you're using in the upcoming year. Let's say like your cash, your inventory, your ARs, etc. And then you have long-term assets which you plan on using long term. Let's say like a warehouse, and your liabilities are also divided generally into two, which is your current liabilities, which would be what you owe to people in the upcoming year, which would a lot of that is your accounts payable. And the long-term liabilities, let's say, which is long-term debt, which isn't due in the near future. And the equity is just the assets less the liabilities. So when we look at working capital, there's different ways of computing it, but it's mainly looking at the capital you're using in an ongoing basis, meaning it'll be looking, sometimes people take cash into account the working capital, sometimes they don't, but it's definitely looking at your inventory, your AR, and your AP, which are also the three parts of the cash conversion cycle, which we're going to be discussing time and time again, which really shows how you turn your inventory into cash. So that's kind of a very high level view of the balance sheet. And then the other one, the cash flow statement, which we discussed, like we said before, you can either look at it directly or indirectly, meaning pulling from the P&L, we're looking at it independently. But in any case, at the end of the day, it's pretty much going to reconcile the difference between cash flow in the beginning of the period and at the end of the period. And it's divided into three different parts. As you can see here, it's pretty much the operating activities, which is like your day-to-day capital, which is cash generated or consumed by your core business activities like buying inventory, like paying your account payables, receiving your account receivables, etc. And then there's investing and financing activities, which are more like your CapEx, PP&E if you're investing, or financing activities related to debt, dividends, etc. But we're going to be focusing, just to kind of put everything in focus here, on the operating activities part of the cash flow statement and on the current assets and liabilities of the balance sheet, which pretty much show what our working capital is. Yeah, go ahead, Jamie.
So interesting discernment point here. In your mind, does the activities associated with marketing, specifically that are not directly related to individual transactions, would that be an operating activity or an investment activity?
So it would depend. I'd say like agency fees generally would hit the operating side. If it's like a
Sure.
long-term investment, then you could argue that it should be more of an investment and more of like a CapEx kind of expense.
Interesting.
Okay, and this is so when you start with the cash flow statement, this is a really important point, and I've had this discussion with various people in the industry. I think a standard should be that everyone should be forecasting their cash out, building like a 13-week cash flow. And that's unfortunately not necessarily the standard. And a lot of times when you take your cash flow statement and you look at what your cash was in a given period of time, you can take that forward and forecast and say, hey, in my next 3 months, and if I could be very granular, break that down into weeks and even into days, this is what my cash flow is going to look like. And you're always the most difficult balance that brands that are inventory heavy have is managing your cash on the one hand and your inventory on the other. And if you can manage your cash flow well and you can project what your sales are going to look like in that period, it'll make it much easier to project your inventory as well. So this all touches on your cash, your working capital. And just something that's interesting is I've seen like time and time again is that a lot of brands in the D2C or CPG or retail space do not have an equal distribution of revenue throughout the year, right? I've seen a lot of our brands that have 60, 70, sometimes even like 90% of their sales, let's say in Q4. Because people have very, very high sales, let's say around Black Friday, Cyber Monday, Christmas, New Year's. Other brands have a different distribution. And maybe if you're selling summer-related items, it'll be more in the summer, etc. But when you, yeah, sorry, Jamie, you want to say something?
Okay, keep going. And when you finish your thought, I've got an anecdote.
Okay. So when you plan out your cash flow, it's really important to take seasonality into account. And you can do that in a few ways. First of all, looking at your metrics from previous years, meaning knowing, again, let's say you have 70% of your sales in Q4, and this is how they distribute between October, November, and December. Second of all, taking individual things into account. Let's say, like, if you're planning on having a significant CAC ad spend in this month, how will that impact your sales going forward? And also taking year over year impacts, which you might not actually think about. Meaning, let's say you look at 2024 and you say, okay, I'm comparing 24 to 25. And in 24 in Q4, we had the elections, right? And especially if you were in a swing state and a lot of the ad spend was being tied up by election-related events, 24 might not look exactly like 25. And if you look at Cyber Monday, so Cyber Monday in 24, I was actually in December. I think this year it's going to be in December as well, but other years it's actually in November. So when you look at year over year and you look at your various metrics, you could take these kind of macro events into account when planning for your cash flow. And there are other things which are very difficult to plan for, which obviously impact your cash flow, like dock strikes. There always talks about that in the end of 24. They're like tariffs, which again are very difficult to plan. And when I started preparing this deck, it looked very different because tariffs were very different back then than they are now. And who knows what they'll be at the end of this 90-day period. But if you don't forecast, you're not going to be able to plan. Forecasting is never accurate. It's always off. But if you don't forecast, you're going to be even more off. So looking at your previous data, trending forward, looking to what your sales will look like on the one hand, and then planning backwards for your inventory. And okay, so if my Sales are, I'm going to need this amount of inventory in this period of time. And my lead time, which it takes me to order my inventory, taking into account everything that's going on with tariffs and how long it takes to order, let's say from China today, is this amount of time. When do I need to actually place my inventory orders? When do I actually need capital? Maybe I need to take a loan in order to bridge this time, etc., is really crucial for managing your cash flow on the one hand and your inventory on the other. So, Jamie, you want to say something or should I go on?
Yeah. So seasonality can hit even very strong brands, even those with 8 figures in sales, if they don't understand it. So sauces and dressings really pick up in the spring in preparation for, and then into the summertime as people want salads and cookouts. As you look at going into the fall, there's a lot of uptick in soups and canned items. But as you get into the winter, you're looking at obviously the holidays, as you called out about the confectionery and the bakery side. And then into January, you're looking at better for you brands. Really seeing an uptick in that time frame. So just knowing how the seasonality of the consumer affects your sales cycle will allow you to plan your cash flow in the way in which you're talking about here, Jacob. Yeah.
Yeah. Thanks for that. That's helpful. Okay, so now we discussed what the balance sheet and cash flow look like, and now I want to dive a little bit into exactly what working capital is and what working capital ratios look like. So first of all, in general, your working capital, the definition of the formula is current assets less your current liabilities, which again is the assets that you're using on an ongoing basis less your current liabilities. A lot of times brands will only look at your inventory, AR, AP. Sometimes cash makes it, sometimes it doesn't. And the working capital ratio is just your current assets divided by your current liabilities. And this is a metric. We're kind of going to be discussing different metrics as we go on. It's a form of a liquidity metric. It shows like how much your current assets can cover your liabilities. And it's something that banks or lenders will be looking at amongst other metrics to see what the chance is that you're actually going to be able to return your liabilities and pay off debt, pay off accounts payable, etc. And this is obviously when someone is extending a loan to you, something that's very important to them because when they underwrite the loan, the real question is what's the chance you're going to be able to pay that loan back? And that's how they determine whether they want to extend that loan. If they do extend that loan, what the effective interest rate will be, which represents their risk. So this is a really important metric. In general, you could see here on the right side, it changes between industries and really ranges between, let's say, 1 to 3, which are like healthy metrics. I just have a lot of times people kind of may use this as a vanity metric, but it's interesting to think about. We're going to discuss this a little bit later on when we discuss the cash conversion cycle. But sometimes you actually want to have a lower working capital. Why is that? Because again, your cash conversion cycle shows how fast or how long it takes you to convert your inventory into cash. It's made up of 3 sides, which we're going to dive into much more later on, which is your days inventory outstanding, how long it takes you from when you order your inventory until you sell it. Your days sales outstanding, which is from when you sell your inventory until you actually collect, which is really important, let's say, if you're selling wholesale. And your days payable outstanding, which is how long it takes you to pay your accounts payable, your vendors and suppliers. So if you're really good, then your cash conversion cycle is actually going to be very low, right? Because that means you're churning cash, you're churning the inventory very, very quickly. You have a good turnover and you're getting paid very quickly. And if it's really good, you might even have a negative cash conversion cycle, which is like the North Star that everyone wants to get to, which pretty much means you don't need external debt because your vendors and suppliers are financing your inventory, which is a great position to be in. So we're going to discuss that more later, but just from a working capital side, a lot of times, what does that mean? If we're looking mainly at inventory, AR and AP, if you have a really good cash conversion cycle, it might mean that the inventory you're holding it for less time, so you have less inventory on your books. Your AR is going to be low because you're collecting it very, very quickly, right? You're getting paid right away. And on the other hand, your AP might be actually very long because you're in such a good position. You can negotiate really good terms with your vendors. So you're only going to be paying, let's say, net 60. So in that kind of case, your working capital might be low because your current assets are actually not so high compared to your current liabilities, and that's not necessarily a bad thing. So when you're looking at your working capital, you have to look at it hand in hand with your cash conversion cycle.
David, just because for me, the graphic was just a little bit fuzzy. So it looked like the food and beverage 50th percentile was around 1.6. Is that right? Meaning, so like
Yeah.
that's that working capital ratio. So if you take your current assets divided by the current liabilities, you're at the 50th percentile, you're at around 1.6 on that, which
1.6. Yeah, something like that.
okay,
Exactly.
which could make you like an okay candidate for things like working like loans and financing, that kind of
Exactly.
stuff.
And if you're very low, then, it could impact whether you are eligible for a loan, or it might impact your interest rate. But again, if you have a great cash conversion cycle and a story to explain it, it might actually make sense that you have lower working capital just because your cash conversion cycle is so unbelievable.
So probably they'd be looking at some kind of a combination of like, also, do you have like revenue and history in the business plus this working capital?
100%. Yeah, yeah.
Yeah,
And other metrics which we'll look at later on. Yes, 100%.
cool.
And just in general, it's worth thinking about that working capital has certain limitations. First of all, it fluctuates a lot based on your inventory sales when you collect AR, AP, and it doesn't really differentiate between different types of assets. And this is a really important point, which we're going to touch on later as well, is AR does not equal cash. There's something called invoice factoring, which a lot of times can actually improve your cash conversion cycle a lot, which pretty much means you sell your invoice as a future receivable and you get paid upfront, let's say 50, 60, 70%. And the difference you get paid when the AR is actually paid out less a certain fee. And depending on who you are and who your ARs are from, you're going to be getting a different amount of upfront and they're going to be taking a different fee. Why is that? It's because certain ARs are worth more than others. If you have an account receivable with with Walmart, with Target, with Costco, it's different than if it's a mom and pop shop, right? So a lot of times when you look at working capital, it doesn't really take into account that your ARs don't really necessarily equal cash or equal each other. And inventory as well, right? A lot of times inventory, people don't necessarily write inventory down in their books. And if you have a big stock from last year, it's not really worth what it's worth, what it's listed as in the books, because you have to sell it at a significant discount. So that's kind of worth keeping in mind when looking at your working capital, is A, the caveat we said before about the cash conversion cycle, and B, that it doesn't necessarily reflect the real value of your working capital, because AR and inventory can be subject to changes. Yeah, sorry, Jamie, go ahead.
Yeah, there's a flip side to that as well, because the inventory may also require age in order to increase value, such in the case of cheese or wine.
Correct.
Yep.
Okay, so now we're going to speak a little bit about working capital efficiency. We're going to speak a little bit about inventory and then AR and AP, a few different points. I think Jamie might have some great operational points here as well. So we'll just start with inventory. So as everyone knows, inventories, can be divided into various categories, from when it's a raw material, when it's in a work in progress, and when it's finished. And a lot of times from an accounting perspective, it's good to kind of divide the materials and the finished goods so you know what you actually have. It allows you to do better cost tracking, insights, COGS accounting, etc. And just one point here, which I think is really important to mention on the tariff side, is that when you look at, when the administration started talking about tariffs, I don't know, back in February or March, people were first kind of saying what's subject to tariffs, and they were saying the entire inventory amount, sale price that you're selling at the store, which is incorrect. And then people kind of realized that's not correct. And they said, okay, it's the value of the inventory in my books. That's not generally correct either. Usually what's subject to tariffs is actually the price of the inventory at the dock when it's being sent to the US. So the inventory will include the product COGS side, will include your freight costs, your insurance costs to bring the inventory to the US. But in general, that's not included in your tariffs cost. That's just like a point that's worth mentioning. Okay. And now I know a lot of brands here are food and beverage brands, and recipes go without saying. You need a recipe to make your cookies, your energy drinks, your protein, etc. But it's interesting to think about, a lot of times recipes can even be with like real goods. Let's just say, and out of other SKUs, meaning let's say you have you sell shampoo, you sell conditioner, and you sell a bundle of shampoo and of conditioner. So in that case, you'd actually be looking at shampoo, which is, let's say, SKU B, conditioner, which is SKU C, and you have SKU A, which is a bundle of SKU A, of SKU B, and SKU C. And when you do your unit economics and you're looking at what your cost should be, and you're making sure that you're not cross-financing between SKUs, and you're also doing your inventory management and making sure you have enough shampoo and conditioner, it's important to keep in mind that you have this bundle of a SKU, which is SKU A. And just two other points here on recipes and bills of materials. One, especially for food and beverage brands, taking yield variance and waste into account is really important from the onset, and knowing, let's say, if you have 5% or 10% waste, which doesn't end up actually being sold, taking that into account when calculating your bills of materials and how that hits your inventory and eventually your COGS. And the second point, which goes to the main point of P&L versus cash, is a lot of times people will think, okay, I'm going to buy in bulk and get a discount, which a lot of times is true, and that does improve your P&L, right? Because your COGS end up being lower. But what does that actually mean? It means that you're, let's say, paying more in advance. And the general way that I come in the past, I worked in kind of investments, and I think when you have a company, you should kind of think like an investor. I say this time and time again. And you should really just think of the alternative trade-offs of the cost of your capital. Meaning, okay, so you can pay in advance or buy in bulk and get a good discount, get a 5% or 7% discount, but then you're going to need to finance that with cash. And then the question is, what interest are you paying on that debt versus the cost that you're saving from a bulk order? And that's something you should always keep in mind and kind of try to model out or ask someone to help you model out, because a lot of times, again, like I keep saying, and I'm going to keep saying this, it's worth trading P&L points, worth having a worse gross margin to actually have cash. So sometimes it's worth not doing the bulk and ordering much later in time, even if it costs you a little more, so that way you won't need to finance, or you'll finance for less time and you'll actually have more cash and need less debt. Okay, and from an inventory management and COGS side, it is very important when you have a recipe to track each component and adjust levels real time, allocate costs properly. And again, this is kind of touches more on the P&L, but a lot of times if you're not allocating costs properly, then your inventory is not going to be accounted for properly, and then your COGS won't be either. And if you're not doing good per SKU analysis, you could end up doing a lot of cross-financing, and you're going to have certain SKUs that are losing and others that are making money, and you're not going to be aware of it. So having really good cost allocation, knowing what goes into each recipe and how much it actually costs you, will help you A, determine your price, and B, see if you are profitable there. And especially taking tariffs into account. And again, even if tariffs are 30% from China on 145%, it still makes an impact. It could still make a 5 or 6% impact, let's say. So you really have to be on top of your SKU analysis from the recipe inventory management side in order to make sure you are not cross-financing and losing. And from the inventory side in general, I think it goes without saying, but it's just important to note, is you always want, you're always trying to kind of balance out. On the one hand, you don't want to be having a lot of inventory sitting in your warehouse or sitting on the shelves of your retailer for a long time. There are a lot of costs associated with that. Like we said originally, you can have really good P&L, but all of your cash is stuck in inventory. You don't want to be there. On the other hand, you don't want to have stockouts and not have enough inventory. So a lot of times, again, it touches on the same point of the P&L versus the cash flow. A lot of times it's worth bundling or promoting inventory, which is sitting for too long on your shelf gathering dust, even if it means that you're going to be paying for it in your P&L and your profit margins are not going to be looking as good. And once you forecast and know your reorder time and know what your cash flow forecasting looks like, it'll help you order your recipes and be on top of it more regularly in order to optimize both your inventory and your cash sides of things. Okay, and then after we have our recipe, the next stage is to assemble the recipe in order to create the finished product. And there's different methodologies and different ideas. And obviously, when you have food and beverage, you have shelf life you're taking into account, which plays a very big part. But you could pre-assemble, assemble to order, and this also touches upon the tariffs question of how much you want to stockpile. We've been talking with a lot of people about this in general. Should we be doing just-in-time inventory? Should we be ordering in advance now that there's this 90-day window? No one really knows, but it is definitely worth thinking about in general, seeing where this meets you, and if you can, and if you are significantly impacted by China, to use this time to try to think about ways to diversifying your supply chain and inventory chain, because we really don't know where things are going to land here. Okay, so just kind of to summarize this last point on inventory management. So we said inventory and cash are two sides of the same coin. If I know how to manage my inventory well, I'm going to have less carrying costs of holding the inventory. I'm going to need less debt to finance the inventory. I'm going to have less cash stuck in that inventory. So I can do demand forecasting, looking at last year's trends, looking at this year's trends, taking my ad spend into account in order to really optimize my inventory management. Okay. Now on to inventory turnovers. Inventory turnover is one of the most important metrics from a working capital side. And what it looks at is how fast you manage to turn over your inventory. Meaning it looks at a given period of time. Usually it's an annual period of time. And within that period, it looks at what your COGS are, which is when you sell your inventory, you're recognizing the COGS, versus your average inventory in that period of time. And the way it works is if the average inventory in the period of time is smaller because it is the denominator, your total inventory turnover will be higher, right? So you want to be holding, the goal is to hold the inventory for less time. If you're holding the inventory for less time, it means that you are churning through it faster, you're getting cash faster, and you can have more sales in that period of time. It's a super important metric. And it shows how efficient you are with cash flow. It shows how much cash is stuck in inventory. If you have good demand forecasting, your inventory turnover should be higher, and you should not have cash stuck again in inventory. So these are basic Finaloop metrics based on all of our brands. You could see here that our top performing quartiles have inventory turnover, which is almost once a month. Again, it really depends on which category you're in and how long it takes to turn over inventory. Our 50th percentile is just about 2.5, and the lowest is about 1.5. So what we generally tell brands is if you don't have a great supply and inventory system, sometimes getting to too high of a turnover, even though it sounds great, and you can end up getting to a negative cash conversion cycle, can be dangerous because you can end up stocking out. But you should definitely be aiming for an inventory turnover on an annual basis of at least 3. And you have stories of some brands, like public brands, let's say like Costco, that have it down perfectly, and they get the inventory turnover of like 12, which means they're turning over all of their inventory once a month. And then if you have good payment terms, you can actually get to a net cash minus cash conversion cycle, which is negative, which means that your APs are financing your ARs. We're going to get to that in just a second. But this is kind of general data on what your inventory turnover might look like. And here we have data based on the median per categories. You could see certain categories here have different turnovers than others. It kind of ranges between 2 to 7 here. But again, even within certain categories, it really can range. But just being on top of your inventory turnover, seeing how long it takes you and how you compare it to your competitors is a really important point to be on top of and aware of.
That's for food and beverage, just because it's a little blurry. It looks like about, 3.6 is the 50th percentile. Health and beauty around 3.
Yeah. So that's kind of around the 3 that we recommend that brands hit, meaning you're turning over your inventory about 3 times a year, meaning every 4 months on average. Yeah.
Jamie, what do you think about businesses that just forecast poorly and build up too much inventory? You're on mute, but I see the rage building up already here.
Yeah, that's a really great way to hide all of your cash in the warehouse and not be able to pay anybody with it. Yeah, you want to make sure that you're turning over, and honestly, some of this is a caveat around shelf life, right? If you have a 6-week shelf life, you're going to have to turn over inventory more frequently, or else the product that you're selling is going to be out of code date, right? So I'd say this is a good benchmark for something with a 12-month shelf life, somewhere between 3 and 4. If you have a lower shelf life than that, it's going to have to be more frequent. Otherwise, you have nothing to sell. And if it has a longer shelf life, I've seen lower, but not frequently
Uh-huh. And that is super key, that part about, because then like distributors will only accept product with a certain amount of shelf life.
remaining. Yep.
That's, although
Mhm.
I did hear a story about a brand that told them that the shelf life was shorter than it was, so that they'd be able to ship in product longer. But just a story that I heard once.
There's a lot of tactical maneuvering that can be taken place there, and I'm going to avoid any specific name dropping in this area because of
It was
the
like a birdie flew through the wind and
uh-huh.
whispered that to me, that they were like, oh, they had a 2-year shelf life, but they said it was only one, so that they could ship it in for longer. Just
Mhm.
crazy stories you hear in this industry.
Or live, as the case may be. Yeah. Sorry, Jacob.
Oh, yeah, sure. Okay, so moving on now from inventory just to ARs, or accounts receivable, which is pretty much the invoices that you've issued and have not yet been paid, right? Meaning people owe you money and you recognize that in your books against income if you're doing accrual accounting. And once you actually get paid, you can recognize the cash. So obviously, if you're selling D2C, it's less relevant if you're selling wholesale, right? Because D2C, you're pretty much collecting right away. Sometimes if you're selling on certain platforms like Amazon, it could take a week or two till you actually get paid out, but it's pretty quick, as opposed to if you're selling wholesale, which it could be much longer payment terms. And being on top of this, also, it sounds like it goes without saying, but we've seen lots of brands that have significant account receivables and they're just not on top of it. They're not aging, they're not keeping an organized, even spreadsheet on their account receivables. So it's definitely worth being on top of and making sure you are collecting it. That's number one. Number two, look at your contractual terms, and if you can negotiate them out, negotiate them, making sure they are better. And obviously, we discussed cash flow forecasting before and taking everything into account, which you project in the next period of time. So when you are projecting account receivables, obviously that should take into account the payment terms. And like we discussed before, the three components of your cash conversion cycle are your inventory, your sales, and your payables. And your sales are pretty much your account receivables, and your days sales outstanding are how long it takes you to convert those receivables into cash, meaning how long it takes to actually get paid from those receivables. And so the account receivable turnover, which is another way of looking at your days sales outstanding, looks at your credit sales in a given period of time divided by your average accounts receivables. And again, thinking from just like a mathematical perspective, if your sales are given in the period, if your account receivables are shorter, then the total turnover is going to be higher. So the higher the turnover, the better your collection is. And if it's very low, it could mean that you have a very poor credit policy, that you're not on top of it, or that you're just really not negotiating too well. But that is another, just looking at like at the inventory turnover, which is kind of the first component, looking at your account receivable turnover also lets you see how efficiently you are collecting your cash, your accounts receivable. Okay, and then the third side of the last metric, the main metric of your working capital is your accounts payable, which is a liability, which is like a current liability in your balance sheet, which shows what you received from suppliers and vendors, goods or services that you have not yet paid. So just a couple of points here is focusing on key bills. Don't take every single tiny AP, but focus on your main ones, which will help you make sure you're focused. B, when you're doing your cash flow forecasting, like we said, taking your AR into account and know when you're collecting, you also know when you're paying, plan to pay. And number three, a point which I'm gonna keep reiterating because it's a little bit counterintuitive, is your accounts payable is your real chance to get to that negative or at least relatively low cash conversion cycle. So a lot of times, if you can leverage your payment terms and not even negotiating and getting a better price, negotiating the price up, but being able to pay later, a lot of times can make a very big difference when looking at your cash conversion cycle. And the account payable turnover, so before we discuss the inventory turnover and the AR turnover, so here it looks at your credit purchases in a given period divided by my average account payable. And I want my account payable actually to be very big, right? Very extended, which means it's taking me a long time to pay my vendors back. So the lower, the better. If it's really low, it might mean that you're just not paying anybody. It's not necessarily a place you want to be in, but the best practice is to try to extend your accounts payable as much as possible, which again will impact your working capital, but that's not necessarily a bad thing, in order to make sure that your cash conversion cycle is as short as possible. And just kind of giving an example, we're not going to get into this in depth here, but if you are manufacturing in China and you can either pay $9,000 on day 0 and $21,000 on day 60 when the goods are completed, that pretty much just means, just conceptually, again, without getting into numbers and calculating effective interest rates, that you need to finance. If you don't have the cash, you have to finance this day 0 for an extra 60 days. Okay. And a lot of times, if you're taking these like short-term loans, we're going to discuss this a little bit later on, your effective interest rate is going to be really, really high. Okay. Like the MC, if you take like a revenue-based loan or even inventory-based loans, a lot of times your effective interest rate could be 20, 30, 40, sometimes even up to like 100% if you look at it on an annual basis and you actually calculate it well. So if you somehow manage to like not pay on day 0 and only pay, let's say, on day 60, even if it costs you a couple of gross margin points, you have to just compare it to what interest you would be paying. And a lot of times, you'd be surprised, it's worth it to pay more and not take out that loan. And it makes things much more efficient, and it makes managing your cash much, much better. Again, your margins aren't going to be looking as good. It's going to hit your gross margin, right, which will eventually hit your EBITDA and your net margins, but it'll leave you more cash in the bank, and it will keep those interest expenses from accruing and from getting bigger and bigger, which is really not a place that you want to be in. Okay, and now taking all of these metrics into account, meaning your inventory and your accounts receivable and your accounts payable, this gives us what we keep on mentioning is your cash conversion cycle. So the cash conversion cycle based on Finaloop data from 2024, a median, again, which looks at all different kinds of companies from different categories, is about 92 days, meaning that's about 3 months, which pretty much means that it takes the median company 3 months to turn its inventory into cash. And this is a bit complex. I'm not going to dive into this too deeply, but Taylor Holiday has been discussing this a lot based on our data, is when you think about how much cash you have left in your P&L after looking at, let's say, what the EBITDA is, even if you have EBITDA of, let's say, 8 or 9 or 10%, because you have 3 months worth of cash stuck in your inventory, because it takes you 3 months to convert that inventory into cash, and that's a certain percentage out of your product COGS, it leaves very little room at the end of the day to take your net cash, your EBITDA or your free cash flow, and actually invest it into growing the company. So it's just worth keeping this in mind when looking at the cash conversion cycle. It means that the average company has 3 months worth of cash stuck in inventory, and that impacts your P&L as well. So shortening this cycle, again, even if it means playing with your margins, might actually be a good way to go. So just kind of to recap here, so it's the cash conversion cycle looks again at your DIO, which is your days inventory outstanding, plus your days sales outstanding, less your days payable outstanding, and the shorter, the better. And there's pretty much 3 ways to optimize it. You can either lower your DIO, which is your days inventory outstanding, by doing really good demand forecasting, let's say knowing how much you actually need, not having inventory sitting for too long, bundling products together, etc. So your inventory turnover is better. You can reduce your days sales outstanding by offering really good payment incentives or using invoice factoring, let's say, which we discussed before, which means selling part of your invoice to a third party, getting a prepayment in advance, and then getting the rest of the payment minus a fee when you actually get paid. That can make your DSO much, much shorter. And it could be a really good way to shorten your cash conversion cycle, especially if you're selling to big wholesalers that have really good terms that these invoice factor brands would wanna buy. And extending the DPO on the other side, which is either negotiating or again trading your gross margin points for longer payment terms, can also extend your days payable outstanding, which in turn decreases your cash conversion cycle. And like we said, the goal is a negative cash conversion cycle, like brands like Costco and a couple of other brands that really managed to hit the nail on this. And then you do not really need external debt. And a lot of these brands, like Costco, at least as of a couple of years ago, had very little external debt just because their DPO, their payables were financing all of their inventory, which is an incredible place to be in. And again, back to my mantra of thinking like an investor, a lot of times after private equity take over brands, like the first thing they do is pretty much fire everyone or fire everyone who's not necessary. But the second thing they do is trying to figure out how to improve your cash conversion cycle and looking at all these things, so the DPO, DSO, DIO. And if you can think that way, not as a private equity, but just as a brand owner and how to optimize your cycle, that can really take your brand to a different place and make your cash management much, much more efficient and better. Okay. Now, so we discussed mainly working capital ratios. I kind of just wanted to speak just for a minute about different ratios and how different third parties will look at your balance sheet differently, right? So let's say, I'd say I divide it into, let's say, 3 different groups. Maybe a 4th group could be like your friends or family who you're bragging to, but I don't know which metrics they'd be looking at. Maybe like growth top line. But the 3 like significant third parties that be looking at your financials would be lenders, like banks, like alternative lenders who are looking at your liquidity ratios, like your quick ratio, your DSCR, your working capital ratio, et cetera, which pretty much looks at your liquidity and what is the chance you can return the debt within this given period of time. And the better chance that you can return the debt, the lower your interest will be, and vice versa, just because these banks or these alternative lenders are getting cash from investors, they need to have a certain return, and that return reflects the risk of the capital extended. So that's one kind of ratio that they're going to be looking at. And as opposed to if you're thinking about, let's say, venture capital or angel investment, and they're going to be looking at very different ratios, a lot more at how fast you are growing, which is more of like a P&L ratio, your churn, retention, et cetera, which is, they don't really care so much about liquidity. They want to make sure you're not closing, but liquidity ratios are less important for them. And like a third group would be like, let's say M&As, and people are looking to buy your company. If you're thinking in that stage or that kind of mindset, which they'd be looking much more at your profitability, at your bottom line, at your EBITDA, how much the founders have an impact, especially in like small CPG or D2C brands, how the product can be integrated into the larger portfolio of brands. So it's worth thinking about balance sheet metrics and understanding them, because you're going to be speaking to different people at different stages of your company's life, and taking into account that different metrics might interest different people. Okay, and one other similar ratio to the working capital ratio that we discussed before is called your operating cash flow ratio, which looks at your cash flow from operating activities, which we said is pretty much your working capital, and that comparing that to your current liabilities. That's another ratio that banks will be looking at a lot of the time. And it's more accurate just from an operational perspective, and banks might like it more because it doesn't look at all these accrual accounting strange stuff that people like me like discussing. It just looks at your actual operating cash. So it gives banks a better picture into what your working capital actually looks like. Like we said, the working capital is more like a balance sheet perspective, and operating is more of an operational, do your operational costs actually cover your short-term debt? And now just a couple of words about debt, which I think are important to bring up, is, like I said, and I'm going to keep saying, think like an investor and try to figure out how much debt costs you versus your alternatives, right? And your alternatives could be equity, raising an equity round. And it could be trying to just survive with your profits. So you should try to think, when you take debt in general, what the return, how much you actually think your company is going to make from this debt. I mean, don't just say, okay, I qualify for this revenue-based loan, or I qualify even for an SBA loan. But if you don't actually think you can make a better return on capital from this debt, then it's not worth it. So you have to really price it out and not just check whether you are eligible for debt, but whether the debt makes sense for your company. And like I said, and I've mentioned this before, and I'll probably mention it again, is MCAs and revenue-based loans are really dangerous. And we see a lot of brands kind of go down that rabbit hole of seeing they're eligible for a merchant cash advance, and they click the button and they get it within like a really quick amount of time. It could be within a couple of days. And then you have a crazy amount of interest and it's tied to your inventory and you didn't sell your inventory in time, and then you need to repay it. So what do? You take out a second MCA and a third one. And then it's kind of, it kills brands. It really kills brands. So before taking out debt, you have to really model out your options really carefully and see what makes sense for your brand. And on the other side, just touching back on equity, because I want to touch the debt to equity ratio, which is an important ratio, is like the equity side is the last part of the balance sheet, which looks at your assets less your liabilities. And just one side point here, which kind of segues into tax, is different types of corporations have different types of equity. And if you are an S Corp, and I know a lot of brands that we work with are S Corps, then equity kind of looks different. And it's just worth thinking and keeping in mind if you are an S Corp that you're only allowed to have one type of shares. And certain things like having even intercompany balances or raising capital as like a safe could impact your equity and your standing as an S Corp in general. So just worth keeping in mind. And when I know what my debt and my equity is, I can look at my debt to equity ratio, which Daniel kind of brought up before. I look at different ratios. I'm not just looking at the working capital ratio. The working capital ratio has a lot of issues, like we noted. So sometimes if I go to a bank, the bank will want to know what my debt to equity ratio is, meaning looking at my entire balance sheet and seeing how much debt I have versus how much equity I have, right? I might want to leverage myself. I might want it to not be I want to have a lot of debt compared to my equity, but it means that I'm higher risk, right? If I'm higher risk, then if things go south and my sales don't do well, or if my inventory gets more expensive, I could be significant risk and liability. So banks will be looking at my debt to equity ratio as well. And when looking at, so I just think kind of my main takeaway from this session in general is to not just look at your P&L, to look at your working capital sides of your ongoing working capital, like your AR, like your inventory, like your AP, and looking at your various balance sheet metrics, not just when you're going to the bank, but looking how levered you are. And are you over leveraged, and how much debt do you actually have, and how much debt do you want to take out? And again, reiterating the point of making sure you actually need that debt, because otherwise things can get very dangerous for your balance sheet and for your brand. Daniel, should we start with the Q&A? Do I have 2 more minutes?
Yeah, I would just, if you want to wrap up, I think that'd be
okay. So we'll just kind of wrap up. So just some key takeaways, insights that we discussed. We went through the balance sheet, the structure of what it looks like, the cash flow statements. We discussed how important cash flow forecasting is, how it impacts your inventory. And we discussed inventory turnover metrics, AR, AP turnover, and various inventory tips, and how this all impacts your cash conversion cycle. And how, in general, thinking like an investor and thinking that a lot of times, like was brought up here before, how cash shortage is what ends up killing brands and killing companies. So a lot of times shifting from your P&L to thinking about your balance sheet and to your cash flow statement is actually a more prudent way to go and a way to build your brand for long-term success.
Okay, Jacob. Oh yeah, perfect. So yeah, if you can just can you just remind everyone what Finaloop does in case they want to reach out to you? And I just posted that link in the chat as well.
Yeah, sure. So Finaloop is an accounting software and service that we provide fully reconciled real-time financials for D2C, multi-channel, omni-channel, wholesale brands, pulling data from your from your stores, from your payment processors, from your bank accounts, from your payroll. We have a proprietary inventory system, which is really cool, based on your POs. And as opposed to like going to a bookkeeper where you're getting your financials, best case scenario, 10 days, 15 days after the month, and you have to make lots of edits and changes and you can never trust it. Here we have on-time, real-time financials, and we have great benchmarking, kind of like some of the data that you saw today and that we showed in the previous session, which allows you to see if you're doing well and how to change things and how to improve so your brand does well. Meaning using your financials to manage and grow your brand and not just to pass on to your tax CPA to make sure that you're compliant.
And speaking of liabilities, how much does it cost typically? What's a range for people just so they know how much it costs to get all the good stuff with Finaloop?
So it really ranges. We have our pricing structure, which is based on revenue size. So it could be from a couple hundred to more, depending on your brand size. And we have additional add-ons if you are interested for more like a managed service. And for a more, I'd say it's called Inventory IQ, which is a really cool inventory system, which automates a lot of the process and gives you landed costs based on your POs.
I guess it's easy for a company that does your books to do revenue-based pricing on you. They know where you're at. So there was a good question, Jamie, I think that I'd love to ask for you that came in through the chat, which kind of summarizes what we're talking about, but for the emerging brand standpoint. So Wilson asked in the Q&A, what advice do you have then for new brand founders? So he has a ready-to-mix beverage, but it has a 2-year shelf life. So just overall, what are you going to recommend for us around working capital for somebody who hasn't really even launched yet and doesn't have sales? And Jamie, do you mind also like telling everyone kind of the overall stuff that you do?
Sure, I'll be quick about that. So, I have my own consulting company that works to help commercialize brands from the technical and operational side of things. Been around for about 7 years now, called Catapult. I also work with the University of Wisconsin and the Food Finance Institute to help educate early brands with financial knowledge centered specifically around the food and beverage sector. So, um, when it comes to thinking about working capital, when you don't have sales yet, that gets to be a problem because as you're looking at assets, you need to look at more of a go-to-market strategy. You're kind of a pre-working capital discussion, really, until we've had some level of traction in sales. So I think you're in the right path if you already know your shelf life, you know where you're trying to be, and things like that. But you need to look at kind of the go-to-market costs before we start looking at a recurring working capital, um, you know, discussion. I think it is important to look at where you want things to be and to model that out so that you have early indicators of whether or not you're going to hit your targets so that you know when reorders need to happen and things like that. But, it's kind of um, the discussion around CCC and things like that are all around companies that are post-launch.
Cool. Okay.
Mhm.
Let's see. Somebody else asked recommendations for ERP for inventory and cash and forecasting, both for D2C and wholesale businesses, somewhere between free online templates and Luminous or Fishbowl. Jacob or anybody want to add?
Yeah, so just to speak a little bit about, so Finaloop, if you use our Inventory IQ, it has a lot of functions which are great for brands in the D2C CPG kind of space. And, it has both financial accounting sides and inventory sides, meaning tracking your inventory units, knowing what you have in each warehouse. I'd say if you're much more advanced, you might want a more advanced inventory management system. But I think for a lot of brands, Inventory IQ could be a perfect fit. So feel free to check it out.
Okay. Jacob, do you mind putting your contact info in here as well? And then I'm gonna put one more time because I
Drop it
know
in
there are
the
a bunch
chat.
of like there are a bunch of questions that came in that were kind of specific to people's businesses. Some that came in around like working with Finaloop, like can you work with them if your bookkeeping is messed up, or can they do prior years? Probably the answer to all that is yes, but you can click on, there's like a contact form that I listed here. You can also email Jacob. He put his email there, and probably Jacob's a nice guy. if you ask him a specific question, I bet he will answer it for you, even if you're not
More than
working.
happy to answer. I got a lot of feedback after the last session as well, and everyone feel free to reach out. I love talking about finance or just in general. Happy to have any discussions, so feel free to reach out through my email or through social media, and I'll be happy to get back to you.
That is great. Cool. Nice to see a nice comment from Marvin saying they use Inventory IQ and they think it's amazing. They had tried several others previously, so it's good to hear. All right, cool. So I just want to thank everybody. Jacob, thank you for putting together all the info in the deck. I can see the comments in the chat are that it was incredibly helpful. And Jamie, thank you so much also for providing some of your perspective, somebody who I respect a lot and have also been in the trenches with many times. So it's always good to have him around for the real deal, given how many brands. And I also, if anybody wants to talk to his team, because like they do cool commercialization stuff, I put the link in the chat. I'll just put it in here one more time. Cool. All right. Thank you, everybody, for joining another session, and hope to see you guys at part 3 in the series, which you should have the link to, but if you don't, just stay tuned on our emails for it.
Thanks so much. Appreciate it.
All right. Thanks, everybody.
Take care.
Bye-bye.